Mohamed El-Erian joins us today, economic advisor at Allianz, who has repeatedly urged caution, Mohamed, for investors for the past several weeks. That caution has been borne out, has been warranted. What now?
Continued caution for most investors. You know, if you're in relative value, if in arbitrage, this is a great environment for you. If you're an agile day trader, that's fine. If you're a long-term investor looking to put money to work, I would wait. And it's not just because of the economics, which we know is concerning because of the sudden stops, the supply and demand disruptions and destructions we're seeing. Carl, we started seeing today more market stress, more liquidity stress. Yesterday it was just the credit market and the inflation market. Today it got to the treasury market. So be careful out there is what I tell people.
Where does that go, that stress? I mean, how bad are things looking in places like the treasury market and the credit market?
So bad enough for the New York Fed to announce a massive increase in repo. So clearly they finally paid attention. They finally are looking at the technicals. So bad enough for that. Look, the concern you have is you don't want a feedback loop. The economy disrupts the markets, and then market malfunction disrupts the economy. We don't want that second loop, because if that second loop kicks in, and I really hope it doesn't, but if it kicks in, it's going to make things a lot harder for policy to act as a circuit breaker. And we're all looking for policy to act as circuit breakers.
It's that kind of urgency, though, Mohamed, the lack of it, that's keeping some of these policy proposals on the Hill, at least, from getting bipartisan support. Thinking of Grassley and payroll tax holiday today. How much urgency do you need to get response?
So I like what I'm hearing in terms of its multi-phase, whole of government. That's great. I also like that the initial focus is going to be on timely and targeted. Remember, the 50 basis points cut did nothing. It arguably made things worse because general policy responses right now are not going to reactivate the economy. They'll help balance sheet, but not reactivate the economy. What we need urgently is two things. One is more resources to the medical side. That's the true circuit breaker for the economy. Give people confidence that the virus will be contained, and give people confidence in immunity. And secondly, focus on the most vulnerable segments, especially the one with systemic risks. That is where all the phase one should be. And then phase two can be more general. And then have the Fed look at market malfunctioning and make sure it does not spread.
What is the moment for you? What is the news headline for you that you would sound more upbeat and that you would say, okay, maybe now's the time to do some buying?
Well, let me first talk about the bottoming out of the economy, because that matters for most Americans. It will be, for all Americans, I should say, it will be when we get signals that the virus is contained and immunity goes up. How do you get that signal like this? Vaccine development. That does it. That starts the bottoming out process. And I agree with the notion that once we bottom out, we have so much stimulus in this economy that it will take off. Not just fiscal and monetary, but also lower oil prices. The markets will turn much earlier, and I'm afraid the turning point now is more likely to be the technical one, the one that we don't like, a disorderly move down that establishes finally the basis for the bounce back up. That's a technical one, and the journey there, Sarah, as you know, is a very unsettling journey for most people.
How much of Italy's experience, Mohamed, is coloring your view of what's headed our way, at least from a public health standpoint?
So I think whether it's Italy, whether it's Boeing, and we can talk about Boeing, whether it's Seattle, these are all extremes. But what they've done for the markets is they've given us some sense of what the left tail, what the really bad scenario looks like. Italy has two issues that scare those of us who talk to the medical professionals. One is that it spreads really quickly. Deaths went up, Carl, by 31% today, daily deaths. This thing spreads really quickly. Two, it's a demonstration effect to the rest of Europe that social distancing, shutting down the whole country, is now a precedent in Europe. which means for economic terms, you paralyze economic activity. So this notion of an economic sudden stop becomes exportable to other parts of Europe. So I view it as helping you understand the left tail. The problem with markets is once they understand the left tail better, they start pricing it. And I think we saw a bit of that today as well.
Yeah, let's talk about Boeing, which finished lower by it had the worst day, 18%, worst day since 1974. One of the bad headlines around Boeing, of course, was that it was tapping the rest of a loan. What does that tell you about where we are in terms of corporate credits and the economy?
So what it should tell you is that Boeing had issues coming in. The initial conditions were weak, the 737 MAX issue. And these funding lines, that's what they're for. That's what it should tell you. But what actually is telling you and is being interpreted, and I think behavioral science is so key here, Sarah, is being interpreted of two things. One is even Boeing is having funding issues. What about the other companies? And the two, you and I have talked about this in the past. Segments of the credit market are particularly fragile. The high yield market is structurally fragile. The massive overhang of BBB minus bonds is very large. So people are starting to worry about the structural fragility of the credit market. And that means you start worrying about the primary issuance market. Because if the high yield market gets disrupted in a major way, more than it has so far, that's going to completely lock up the market for new bond issuance.
Right.
So those are the two messages.
Mohammed, we just came out of a meeting with the president and bank CEOs where the message was the structural integrity of the financial system, how this is not 2008. It doesn't sound like you necessarily agree with that.
No, this is not 2008 if you define, and it's critical to understand how you define it, as a problem of the banking system that contaminates the payments and settlement system. The payments and settlement system is the oil that makes everything work. And in 2008, that got contaminated. And the minute that gets contaminated, then things come to a halt. That's not what we're looking at. The banking system is in good shape. The payments and settlement system is in very good shape. The problem is that risk migrated from banks to non-banks. And it took on the form of credit risk, equity risk, and liquidity risk. The system, the non-banking system, has overpromised liquidity to end users. So if you ask me about the banks and the payments and settlement system, that is rock solid. But if you ask me about the non-banks and how that can contaminate the real economy, that's why I start worrying. And the big other difference, go ahead.
No, I just, before we're out of time, but I really want to ask you what on earth Christine Lagarde is going to do tomorrow.
I hope she follows the example of the Bank of England. They gave us a very powerful, good example to follow, which is not only cut by 50 basis points or cut by whatever you can in the case of the ECB, but also have very targeted measures to address the fragilities, in their case, the small and medium-term enterprises, medium-sized, and also have it in terms of coordination with other fiscal agencies and other agencies. That is, the Bank of England set a very good example for other central banks today.
Mohammed El-Erian, thank you for joining us.
Thank you.